Trump 2.0 has been anything but boring for the economy. From day one of his return to the White House, investors learned to expect the unexpected. The only sure thing was an uncertain economic outlook. Why? Consider his trademark economic moves. First, tariffs. Trump calls them beautiful, and he isn't shy about using them. At various points, he's floated tariffs of 10% on all imports, 25% on goods from neighbors, even 60% on Chinese products. These aren't just numbers, they're body blows to global supply chains and corporate earnings. Even the rumor of a new tariff can send stocks tumbling. Investors remember that during Trump's first term, tariff announcement days coincided with falling stock prices and spiking volatility. Now in his second term, the specter of Trade War 2.0 looms large. Companies don't know if next week they'll wake up to a new import tax or trade restriction. This policy whiplash has made the market extraordinarily twitchy. Geopolitical tensions compound the jitters. Under Trump's go-it-alone foreign policy, global alliances are shakier and conflicts simmer. Relations with China are frosty. One day it's a trade deal, the next it's sanctions and naval standoffs. Each flare-up on the world stage feeds market instability. It's hard for investors to price assets when, say, a single headline about South China Sea tensions or a tweet about OPEC can swing oil and currency markets. We're essentially dealing with a market allergic to unpredictability, and unpredictability has been the hallmark of Trump's governance. Then there's fiscal policy. Trump's tax cuts and spending sprees have ballooned the federal deficit to record levels. Yes, businesses enjoyed deregulation and lower taxes. That's partly why investors initially cheered his re-election with a rally. But those sugar highs come with side effects. A huge federal budget deficit and heavy government spending stoke worries that inflation could reignite. If prices start rising faster again, the Fed might have to halt its interest rate cuts and even hike rates unexpectedly. That would be pouring cold water on the economy and, by extension, the stock market. As T. Rowe Price analysts warned, Trump's policies carry the risk of upending market optimism by rekindling inflation concerns. In plain English, more uncertainty, more volatility. Put it all together, aggressive trade policies, global political drama, and fiscal uncertainty, and you get a wildly seesawing market. One week, investors bet on deregulation and bid stocks up. The next, a tariff threat or diplomatic spat sends everyone running for cover. It's enough to give even seasoned traders whiplash. Extreme uncertainty is the new normal, and stock prices are reacting accordingly with big swings up and down. So yes, it feels like the market is screwed, but feeling that way and acting on that feeling are two different things. History strongly suggests that acting out of panic now would be a grave mistake. Let's see why staying calm and invested is the smarter path. When markets plunge, the impulse to panic sell can be overwhelming. Watching hard-earned wealth shrink is scary. It's human nature to want to do something when chaos hits. But here's the hard truth: panic is toxic for your financial health. In fact, dumping your investments in a frenzy is often the surest way to turn temporary losses into permanent ones. History offers plenty of proof. Market crashes are not a new phenomenon, and neither is the recovery that follows them. Time and again, the stock market has clawed its way back from crises, rewarding patient investors who didn't bail out. Those who did sell at the bottom usually lived to regret it. All too often, investors who panic during a crash lock in losses and possibly miss the rebound. In other words, they sell low and then miss the subsequent surge that could have restored their portfolio. It's the classic failing of market timing, getting out at the wrong time and never getting back in until it's too late. Let's talk examples. The 2008 financial crisis is a great case study. In 2008 and 2009, stocks were in free fall. The S&P 500 plunged over 50% of its value at the depths of the crisis. It truly felt like the end of the financial world. Banks were failing, credit was frozen, and pundits proclaimed capitalism itself might collapse. Many investors understandably thought this time is different and fled to cash. But what happened next? The market bottomed in March 2009 and began to recover. By 2013, the S&P had regained its pre-crisis high, and it kept climbing. In the decade after the crash, U.S. stocks went on an extraordinary bull run. An investor who stayed invested, or better yet, bought more at the lows, saw enormous gains as the market eventually not only recovered but soared to new records. Meanwhile, those who sold in panic in late 2008 missed one of the greatest buying opportunities of a generation. 1 year after the worst days of the 2008 crash, the market was already rebounding strongly. Historically, after the 10 worst single-day plunges since 1980, the S&P 500 was up by double digits a year later in all but one case. The lesson: even the ugliest crashes are temporary, and if you run away, you run the risk of not being there for the recovery. Fast forward to March 2020, the COVID-19 pandemic market collapse. The S&P 500 nosedived 34% in just over a month, one of the fastest bear markets ever. Fear and uncertainty were at extreme levels. It felt like 2008 all over again, compressed into weeks. Yet the snapback was just as extreme. Markets recovered from the 2020 COVID crash in only 5 months, recouping all those losses by August 2020. Investors who sold at the bottom in despair missed out on a lightning-fast comeback. In fact, some of the best days in market history occurred amid that crisis. Here's a striking statistic. Of the 30 strongest single-day stock market gains in the last 30 years, 24 of them happened during 3 of the worst periods: the early 2000s dot-com bust, the 2008 financial crisis, and the 2008 pandemic crash. That's right, the biggest up days tend to cluster right next to the biggest down days. If you were out of the market, hiding in cash, you missed those huge rebounds. Studies have shown that missing just a handful of the market's best days can decimate your long-term returns. It's practically impossible to sell at the bottom and then perfectly time your re-entry to catch those rallies. More likely, you sell after stocks have already fallen a lot, then you sit on the sidelines in safety while the market rockets upward without you. All of this underscores a famous investing adage: time in the market beats timing the market. Staying invested through the turmoil beats trying and usually failing to guess the perfect exit and entry points. Yes, it's painful to watch your account balance shrink during a crash, but remember that those losses are on paper. History suggests they are temporary, unless you turn them into a real loss by selling. The investors who held on through crashes, or added more at the lows, have consistently come out ahead of those who fled. Every crisis feels unique and terrifying in the moment, but the long-term trajectory of the stock market has been upward. Since 1928, despite all the crashes, depressions, wars, and shocks, the U.S. stock market has delivered roughly a 10% gross average annual return, or about 7% after inflation over the long run. That long-term growth is the reward for those who endure the short-term storms. So when you see the market plunging and feel the urge to panic, think of 2008, think of 2008-20, and remind yourself how quickly things turned around. Panic is not a strategy, it's a trap. If panic selling during a crash is the worst thing you can do, what's the best? In one word, opportunity. A market downturn is often the sale of the century for investors, a chance to buy stocks at bargain prices. It may sound crazy to buy when everything looks horrible, but that's exactly what the greatest investors do. As Warren Buffett famously said, be fearful when others are greedy, and be greedy when others are fearful. Right now, a lot of people are fearful. That means many stocks, including shares of great companies, have been beaten down well below their true value. For a long-term investor, this is an invitation to go shopping in the stock market's bargain bin. Of course, it takes courage and discipline to step in while others are fleeing. That's where a strategy like dollar-cost averaging comes in as your secret weapon. Dollar-cost averaging is a simple yet powerful approach. You invest a fixed amount of money at regular intervals, say monthly or quarterly, no matter what the market is doing. When prices are high, that fixed amount buys fewer shares. When prices are low, like during a crash, the same amount buys more shares. Over time, this strategy naturally lowers the average cost per share and reduces the impact of volatility on your portfolio. In essence, dollar-cost averaging forces you to buy low more often without trying to time anything. It takes the emotional decision-making out of investing. Instead of worrying whether now is the right time to buy, which is what trips up most people, you stick to a schedule: rain or shine, boom or bust. This approach removes the burden of timing the market and keeps you investing steadily through the turmoil. During a bear market, dollar-cost averaging is especially powerful. You're automatically buying stocks at discounted prices when pessimism is high. When the market eventually recovers, and remember, it always has historically, you'll own a lot more shares that were purchased cheaply. That can supercharge your gains in the long run. Think of it this way. If you loved a stock at $100, you should really love it at $70. That's a 30% off sale. Yet, human psychology is funny. Most people feel worse about a stock after its price has dropped. Dollar-cost averaging helps counteract that bias by making sure you're consistently investing, turning market weakness to your advantage. It's the equivalent of gradually loading up your shopping cart with goods on clearance. You may not catch the absolute bottom price, but you will get a solid average price over time, often closer to the lows, and you avoid the nightmare scenario of dumping all your money in at a peak right before a crash. Many advisors actually test this. A study by Charles Schwab compared different tactics: investing everything at once at the perfect time, investing right away without timing, spreading investments via dollar-cost averaging, investing at the worst times, or not investing at all. The result? Perfect timing did best, of course, but the next best outcomes were from investing immediately or through steady contributions, aka dollar-cost averaging. The worst outcome was not investing at all. The takeaway is clear. Getting money into the market sooner rather than later and keeping it there beats waiting for the perfect moment. Now, let's highlight some real-world rebounds that show the payoff of staying the course and buying during downturns. Consider Apple during the 2008 crisis. Apple's stock got absolutely pummeled in 2008 along with everyone else. The iPhone revolution was underway, but in a market crash, even great company stocks fall. If you had the courage to buy Apple amid that panic, you were richly rewarded. As the world economy began to recover in 2009, Apple's stock flourished, rising by an astounding 147% that year alone. That's right, Apple more than doubled in 2009, bouncing off the lows to new heights. Many people who sold in 2008 missed that huge upside. Or look at Amazon. Amazon's stock was hit hard in late 2008, but those who saw Amazon's long-term potential and either held on or bought more shares have absolutely crushed it. In the years since 2008, Amazon stock has gained over 2,000%. To put that in perspective, an investment of $1,000 in Amazon at the 2008 crash lows would be worth around $20,000 to $30,000 today. Even broad index funds like the S&P 500 have delivered stellar returns if you bought during downturns. Buying an index fund in March 2009, the pit of the financial crisis, and holding it for the next decade yielded annual returns well into the double digits, as the market not only recovered but went on to numerous record highs. The key point is that downturns don't last forever, but the decisions you make during them can have lasting consequences. Every bear market in history looks, in retrospect, like a golden buying opportunity. This one is no different. Stocks are on sale due to fear and uncertainty. If you have a long-term perspective, you want to be the shopper in these clearance sales, not the seller. Now, this doesn't mean you throw all caution to the wind. Sensible investing rules still apply. Diversify your holdings, maybe add some international stocks, and make sure your overall portfolio matches your risk tolerance. It's also wise to keep some emergency cash so you're not forced to sell investments at a bad time. And yes, there are other asset classes beyond stocks. Bonds, for example, tend to hold up better in downturns and can provide stability. In fact, during these volatile times, high-quality bonds are yielding nicely and acting as ballast. Gold and other commodities sometimes shine when stocks sink. There's nothing wrong with a balanced portfolio that includes these. But for growth and building wealth, equities remain the star of the show. Over the long run, stocks have far outperformed bonds, gold, and cash. Remember that 10% historical annual return of the stock market. That's the premium you get for tolerating short-term volatility. To capture that, you have to stay in the game even when it's stormy. So the smart move now is to ride out this storm and use it to your advantage. Continue contributing to your retirement or investment account on a regular schedule. If you have extra cash and your emergency fund is solid, Consider incrementally putting some of it to work in the market while prices are depressed. Focus on quality companies or index funds. Think of companies with strong balance sheets and durable businesses. Many of them are trading well below their highs because of fear, not because their business prospects have fundamentally changed. These are your potential winners when sanity returns to the market. By buying steadily now, you're positioning yourself for the eventual rebound. It might take months or even a couple of years, but history suggests that when the rebound comes, it can be swift and robust. The investors who treat downturns as opportunities, not disasters, are the ones who come out on top. Market crashes are terrifying in the moment. There's no sugarcoating that. It's easy to feel like the world is ending when you see a sea of red on your screen and media outlets proclaiming financial apocalypse. But here's what you need to remember above all: market crashes are temporary, but the decisions you make during them can be permanent. The storm will pass. It always has. The stock market has weathered world wars, depressions, pandemics, and political upheavals of all kinds, and it has always found a way to recover and move higher over time. Those scary drops you see are the price of admission for the long-term gains that equities provide. As an investor, your job is not to predict when the storm will end, it's to ensure you're still standing when it does. Think of it like being on a turbulent flight. You don't jump out of the plane when it hits rough air. You buckle in and trust that the turbulence will pass. In the same way, don't abandon your investments in a panic. Stay buckled in. Stick to your long-term plan. In 5, 10, 20 years, when you look back on this period, it will likely appear as just another dip on the long upward graph of market history. In fact, you might be thanking your former self for having the fortitude to keep investing when things looked bleak. The mantra, "this too shall pass," applies well to markets.